Assalamu alaikum friends, welcome to IAS 19 Employee Benefits. IAS 19 is one of those standards which is not covered in your financial reporting paper. So definitely you need to study this in more details. Those standards which are not tested in financial reporting has more chances, okay, of coming in SBR. Okay, so IAS 19 is also one of the standards which comes regularly. So let us go through employee benefits. Now, before we go to in detail, let us go through this chart. Types of pension plans. You need to know that there are two types of pension plan. One is known as defined contribution plan. The other one is known as defined benefit plan. Okay, and there are some other types of employee benefits because the chapter's name is employee benefits. So pension is one form of benefit, right? But there are other benefits also other than pension, which are known as short-term employee benefit could be there, or termination benefit, right? You're terminating an employee, you're giving them some compensation, so that is known as termination benefits. Then we have other long-term employee benefit also. So in IAS 19 we are going to go through all this, but mostly which is very important is the pension part, how you deal with the defined contribution plans and defined benefit plans. So starting we okay, so this is some employee benefit. There are four types of employee benefits: post employee benefit, short-term employee benefits, termination benefits, and other long-term employee benefits, right? Post-employee benefit, for example, retirement. That means post-employment means after your employment gets over. While you are in the employment, you will not get this benefit. It is after you have completed your employment terms. For example, one example is retirement benefits, okay, which is post-employee. Next, short-term. Short terms are your wages and salaries and bonuses and other benefits, okay. Then we have termination. So when an employee is terminated, we pay this benefit. It's known as termination benefits. Okay. It could be either by the employer or by the employee accepting terms to have employment terminated. Okay. So next we have long-term employee benefits. So this are those items which are not there in the above categories. Okay. They are neither termination nor short-term nor post-employee. Okay. They are for long-term leave, for example, long service leave. Okay, or awards, right? Maybe you might get an award for being the most hardworking employee or the loyal employee. You have been there in the 20 years or 30 years in the organization. You have been given an award. So these are long-term employee benefits. You might be given long-term disability benefits also, another long-term service benefit. Okay. So each will be considered within this chapter with particular emphasis upon post-employee defined benefit plans. So the most important thing is the first one, first category, post-employment benefit, right? The defined benefit plans. Post-employment defined benefit plan. This is the most important. Mostly it will be focused on this only. Others will be briefly explained later on as we proceed. Okay, so this is not examined in financial reporting. This is new to you. Something which is new to you has more chance of coming in SBR. Obviously, that does not mean that the ones topics which have been tested in financial reporting will not come, but this definitely will come. Okay, IS 19. So post-employment benefit plans. Okay, because definitely pension and all you will get after your employments are over, post-employment. Okay, so that falls into post-employment benefit. Post-employment IS 19, this can be uh, integrated in other case study, other questions. For example, this could be asked in IS 7 where you have to make statement of cash flows. There you need the help of IS 19 sometimes. Some part is related to pension. There you need IS 19, or maybe in group accounting. Okay, there you need IS 19. So IS 19, it could be integrated with other standards also. Okay, so let us read this. A pension plan sometimes call a post-employment benefit plan. Okay, so see, it could be written as pension plan, or sometimes they might refer as post-employment benefit. Most of the time they write post-employment benefit. So it should be understood that the moment you see post-employment, it is IS 19 relating to pension. Okay, So it consists of assets together with liability for pensions owed. Okay. So pension plan assets. You should know there are two things. One is pension plan assets, the other one is pension plan liabilities. Okay. Pension plan assets. What does it consist of? Investments, cash, sometimes properties, like how normally other assets are, right? So for pension also we have this investment, cash, properties. The return owed on the asset is used to pay pension. There are two types of pension plan, two types. You should know the difference between those two because some of the revision gate questions have these questions. If you have gone through, you must have seen that. Define it and then then differentiate between the two types of plan. Okay. So first we are going to go through defined contribution plan. The definition is here and then defined benefit plan. Okay. So defined contribution plan, what is it? They are benefit plans where the entity pays fixed contributions into a separate. It's already bold. Okay. So everything is important here. Entity pays fixed contributions into a separate entity and will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to their service. What does it mean? Only they will pay a fixed contribution only. Okay. If their asset is less than their liabilities, they don't have that obligation that they have to contribute more. That's it. That is known as defined contribution. Contributions are defined, in other words, if you want to remember this. The benefit difference between defined benefit. Defined contribution is like contribution is defined as fixed. Okay, so the word is contributions is fixed. Let's say I'm paying 20,000 in the pension, so it's 20,000 only. Okay, I will not have that obligation to pay more than 20,000 if I cannot pay. Okay, so there is no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits related to their service. But what is defined benefit plans? Are post-employment benefits that are not defined contribution plans. You can change your contribution, increase or decrease. It's not defined. It's not fixed. Contribution is not fixed. Okay, so let us go through some examples. Of both examples we'll go to see the difference. Okay, with this example you should know. It's very clear-cut example. An entity pays a fixed contribution of 5% of employees' salaries into a pension plan each month. The entity has no obligation outside of its fixed contribution. Okay, the lack of any obligation uh, to contribute further assets into the fund means that this is a defined contribution plan. Okay, first of all, contribution is fixed. Then they don't have any obligation to contribute further assets into the fund. Okay, they have no obligation outside of his fixed contribution also. So this is defined contribution plan. Contribution is defined. Okay, defined contribution. Everything will be fixed, and no obligation. These words will be there for you to understand whether it's defined contribution or defined benefit. Sometimes remember, they will give you some plan. You have to differentiate, you have to understand, define whether it falls under defined contribution plan or defined benefit plan. Now let us go to defined benefit plan. An entity guarantees a particular level of pension benefit to its employee upon retirement. Okay, particular level of pension will be there for the employees once they retire. So the annual pension income that employees will receive is based on the following formula. This formula you use when it's defined benefit. Okay, what is it? Salary at retirement into the number of years worked, because retirement age they say 60 years, more than that you are resigned. So 60 is the total. Out of that, how many years you have worked? Let's say 30 years. So it will be 30 over 60 into your salary at retirement. This is how they will give you the benefit. Here they have an obligation. When it's defined benefit, obligation is there, extra to pay extra fund. So entity has an obligation to pay extra fund into the pension plan to meet this promised level of pension benefit. This is therefore defined benefit plan. Okay. Test understanding will be done at the end after I finish IAS 19. Now we are accounting for defined contribution plans. Remember, we are accounting it in a different way. First, let us start with defined contribution, then we'll go to defined benefit. Okay. So entity should charge the agreed pension contribution to where? Agreed pension contribution is charged in profit and loss as an employment expense each way. This is an expense, right? All the benefits, whatever you're giving to employees, are expense from your side. So it will be recorded in the profit and loss as an employment expense, okay? Whatever pension contribution you have agreed. Now, the expense of providing pension in the period is often the same as the amount of contributions paid. So whatever the contributions you have paid, that will be only your expense. Okay, so your expense is equal to your amount of contributions you have paid. Let's say you have paid 10,000 in the contribution. That is only your expense. It's equal. Okay. It's often the same as the amount of the contribution paid. Most of the time. Whatever the expense relating to provide that pension in the period. So, however, an accrual or prepayment arises if the cash paid does not equal the value of the contributions due for the period. Right? Sometimes you may pay late, sometimes you may pay before. So that time, whatever cash you have paid might not equal to the value of the contribution. So test your understanding 2 is for defined contribution scheme. Next we have account for defined benefit plans. This is the most important area for IAS 19 because most of the questions are asked in this one, the second type, which is defined benefit plans, more than the contribution plans. Contribution plan also might come, but defined benefit, it's always asked. Okay. So how do you account it in the statement of financial position and year on year movement? That means what will go in the profit and loss account. You should know the impact in both the places of employee benefit. So under a defined benefit plan, an entity has an obligation to its employee, isn't it? This is like an obligation. You have to pay your employee when they retire their pension. So the entity there has a long-term liability that will measure at fair value. Okay, that must be measured at fair value. This is like a long-term liability for the entity. Okay, and that must be measured at fair value because the pension may be paid later, but today you have to find the present value of that future pension that you are going to pay. So it's from today it will be a long-term liability because when you are measuring now it's like a long-term liability for you. You will be realizing that pension later in the future, but you started calculating from today, then it's a long-term liability because that will be paid in the future. So it is measured at present value. Okay. The entity will also be making regular contributions into the pension plan. Yes, there is a long-term liability, but apart from that also they will make regular contributions into the pension plan because they have the obligation. Remember, this is not a fixed contribution. So they have to make regular contributions into the pension scheme. Okay, this contributions will be invested and the investments will generate returns. So this contribution they invest and that investment generate returns. So this means that the entity has assets held within the pension plan. So because they're generating returns from it, that means they are having asset also in that pension plan. Okay, so the assets when they have in the pension plan, okay, which IAS 19 states must be measured at fair value. That must be measured at fair value. Okay. So now if I have to summarize this whole the two paragraphs, pension benefit asset, okay, or defined benefit plan asset is measured at fair value, and when it's a liability it is measured at present value. On the statement of the financial position, an entity offsets his pension obligation and his planned assets and reports the net position. This is very important. You offset. If you have a obligation, pension obligation, that means that's a liability, and planned asset. What do? You don't show it separately. You show the net position. You deduct your obligation from the planned assets and show the net position in the statement of financial position. When these two things happen, what are the two things? If the obligation exceeds the asset, because it is obligation minus the asset, so it should exceed the asset. If obligation exceeds the asset, there is a planned deficit. Okay. So in the statement of financial position, net position, how do you write? There's a name for that net position. It is known as either planned deficit okay, or it is known as surplus. When is it a planned deficit? When your obligation exceeds asset. It's a deficit. It's a usual situation. That means liability is more, so the liability is reported in the statement of financial position. But if the asset is more than the obligation, it's a surplus. And asset is reported in the statement of financial position. Okay, to understand this better, do questions from revision kit after you go through this. Mm. It is difficult to calculate the size of the defined benefit pension obligation and plan assets. Okay, it is therefore recommended that entities use an expert known as an actuary. Okay, so he is an expert who values, who calculates the size of, or who estimates a size of what is the pension obligation and what is for the plan assets, because this area is very critical and is very difficult for normal person to do it. So you need experts for such field. Okay, so the person is known as actuary. Year on year movement. Now we are coming to the profit and loss account. Okay, and definitely in the profit and loss account we always write the movements, what's happening, not the whole amount. So entity must account for the year on year movement in its defined benefit pension scheme, deficit or surplus. Okay, year on year the balance changes, there will be some movement. Okay, whether it is defined benefit deficit or surplus. So remember this pro forma, even in the exam this will help you. Okay, so this shows the movement on the defined benefit deficit or surplus over a reporting period. Okay, if it's a deficit you show it as a positive figure, if it's a surplus you show it in the negative. Okay, so if it's a net deficit it is in a positive figure, and when it's asset it is in bracket. Don't forget this bracket and without bracket part. Okay, for asset bracket, for deficit without bracket, and learn this, memorize this pro forma. So you always start with the brought forward balance in the exam most of the time. Okay, not most of the time, 100% of the time brought forward balances will be given to you, so you don't have to worry about it whether it is deficit or whether it is asset. Next, these things you need to, maybe it will be given to you, right? Maybe you have to do some working and get the figure. Most of the time it is given actually, because what they are bothered about is to find the remeasurement component, okay, which is a balancing figure. So on that you add net interest component. Net interest component you add. Okay, that net interest is on this brought forward balance. Okay, you always take on a brought forward balance some interest, it will be given to you, don't worry, applied, and then you will get net interest component. Then you have a service cost component, it will be given to you, and also how much contributions into plan, that is also will be given to you. So contributions into plan you deduct. Okay, so here this is, if it's a deficit it's a positive figure, if it's asset it's a negative figure, and here net interest. So if net interest is on deficit then it's a positive figure, if the net interest is on asset again it's a negative figure. Okay, but service cost if you see it is always added only, whether it is net asset or whether it is net deficit, that's why it's without bracket. Service cost, same for contributions into plan, is always deducted. Okay, no matter whether it is a net deficit or an asset, it is brought minus only. Okay, and finally benefits paid, which is in this case they don't have any benefits paid, but they might have times. So remeasurement component is the balancing figure, because closing balance also they will give to you, whether it is net deficit or asset. If deficit positive, here also if asset negative. Okay, so here they have told why deficit is a positive figure, because it is obligation minus the asset carried forward. You see, if the obligation amount is greater, definitely this will be a positive figure, right? That's why obligation net deficit is a positive and asset is a negative figure. Okay, remeasurement. So after you get this part and the closing is balanced, whatever is there is a remeasurement component, which is a balanced figure. So you will get a positive figure if it is deficit and a negative figure if it's an asset. So make sure that you go through this and you memorize this pro forma. It needs to be memorized. Now let us go one by one item we are going to go. So we are starting with net interest, then we are going to service cost component. Okay, then we are going to the contributions into the plan, then defined benefit into the plan. So all these things we are going now, we are going to go one by one. Net interest. This is simply the interest on that. So that interest, it is charged into or credited to profit and loss. It's like a finance cost. Okay, and represents the change in the net pension liability or asset due to the passage in time. It is computed by applying the discount rate at the start of the year to the net defined benefit liability on asset. Okay, net defined benefit. So you will be given some discount rate at the start of the year that only you need to apply to the opening balance. That's how you get the net interest component and it is in the profit and loss account. Okay, so only that you need to remember. Now let us go to the service cost component. This is also charged to profit and loss, but it comprises of three elements. All the three elements you should know. Okay, one is current service cost, one is past service cost. If you have gone through a question on IAS 19, you must have seen this word. It's always repeated. Past service cost, current service cost, past service cost, and a gain or loss on settlement. But we'll go to the third one later. First, let us go to the current service cost. Current service cost means it is in the current period. Okay. So if it's a current service cost, which is the increase in the present value of the obligation arising from the employee service in the current period. That means it will increase your present obligation. These are service cost to service your employee. Okay, employee service arising from employee service. So there will be an increase in the value of obligation in the current period. Okay, if it's a past service cost, what happens? It is the change in the present value of an obligation for an employee in the prior period, in the before period, not in the current period. Okay, resulting from a plan amendment or curtailment. Okay, so past service cost can come from these two things. You either amend the plan or curtailment. We'll see what a plan amendment and curtailment means in detail a little bit later. Okay, any gain or loss on settlement. Okay, we'll definitely go through all this in detail. So it comprises of the three elements, the service cost component. One is current service cost, past service cost, and gain or loss on settlement. Let us go to the past service cost. It arises when there has been an improvement in the benefit to be provided under the plan or where there has been a curtailment. Okay, so sometimes you might have improved the plan, the benefit to the employees. What should you do? Under that same plan only. Or you might have, or there has been a curtailment. Okay, what is the curtailment means? The definition is given just below it. It is a significant reduction in the number of employees covered by a pension plan. Okay, this may be a consequence of employees being made redundant. Yes, because if you're sending employees, okay, if employees are leaving your organization, you don't have to pay them pension. You're not obliged to pay them pension. You're only obliged to pay them pension if they are employed in your company. Now they have finished and they are not being employed anywhere else. They are not being made redundant. Okay, it's just they have finished their surveys or they have reached their retirement age. That time only they will get the pension. So that means that pension amount what they have to pay to the employee will reduce significantly. It will reduce. So it's a curtailment, right? Or maybe more employees came during the period. Now you have to pay more benefits to them. So it is known as improvement in the benefit or curtailment. Curtailment means reduction in employee benefits. So you should know when the past service cost should be recognized, when the current service cost should be recognized. Current service cost is easy, it is in the profit and loss account as an expense, but when it relates to past service cost, it is recognized at the earlier of these two dates. What is it? When the plan amendment or curtailment occur, amendment means you are changing the plan, okay? You are changing the plan, improving it, you're paying to more employees or not paying, you're paying less, which is known as curtailment. So when the entity recognizes related restructuring cost or termination benefit, when they recognize a related restructuring cost or termination benefit, whichever is earlier of this two, you recognize the past service cost at that date. If you have recognized the restructuring cost before the plan changing the amendment, then it is at the date when you have recognized the restructuring cost, the past service cost should be recognized. You understanding? We'll definitely do a question on this to understand better. But definitely after you go through this and when you try to do IAS 19, you definitely will understand how to apply IAS 19. It's knowledge part. See, this is the knowledge part of IAS 19. Application part will be shown in the revision kit. Okay. Now let us go to the settlement. A settlement occurs when an entity enters into a transaction to eliminate the obligation for part or all of the benefits under a plan. Let's say you have an obligation, so now you are settling so that your obligation reduces. So it's like to eliminate it. Either you eliminate the obligation for part or all of the benefits under a plan, right? Definitely when you have an obligation, you want to make a settlement and make your obligation zero, either completely or either, but you want to reduce it, if not full but at least partially or fully. That is a settlement. Okay. For example, an employee may leave the entity for a new job elsewhere and a payment is made from that pension plan to the pension plan operated by the new employer. Okay. So it changed from the old employer's pension plan to the new employer's pension plan. So the gain or loss on settlement is the difference between the fair value of the plan assets paid out and the reduction in the present value of the defined benefit. This part. The gain or loss on settlement. Remember, when you are having settlement, there might be a gain or loss. Why? Because of the difference between the fair value of the plan assets paid out and the reduction in the present value of the defined benefit obligation. Okay. So the gain or loss forms part of the service cost component. So that gain or loss will also be included in the service cost component. So it's a difference between the fair value of the plan assets paid out and the reduction in the present value of the defined benefit obligation. You're reducing it, your benefit obligation will reduce, that's why reduction, and also the fair value of plan assets paid out. So the differences would be gain or loss. Now let us go to the contributions into the plan. These are usually cash payments only. Okay. So these are cash payments paid into the plan during the reporting period by the employer. This has no impact on the statement of profit and other comprehensive income. Okay. So contributions have no impact in the statement of profit and other comprehensive income. But remember, this have an impact in the statement of cash flow because this is cash paid. So you have to deduct this in your cash flow statement under operating activities because this has an impact. Okay. But in the statement of profit and loss and other comprehensive income, they do not have impact. But other things have impact like your service cost, your net interest. This will go in the profit and loss account. But not the contributions into the plan. What about the benefits paid? Remember this pro forma? There was no benefits paid for this, but at times you might have the benefits paid also. Amount will be given for the benefits paid, right? So now they are describing it. What is the benefits paid? So these are the amounts paid out of the plan assets to the retired employees during the period. Okay, you are paying that benefit out of that plan asset, whatever the amount you are paying out to the retired employees. Okay, so this payment reduces both the plan obligation and the plan assets. What happens? If you are paying the benefit, that means you have to deduct this, whether it is planned obligation or planned assets, because it will reduce both of them. How it will reduce both of them? Planned obligation, because now once you have paid that benefit to your retired employees, that means the pension has been paid to them, so it will be reduced from your balance, the plan asset. That obligation will reduce. You will not have that obligation anymore because you've already paid. So obligation will reduce. Plan asset, because you have paying out from the plan asset. So the carrying amount in your fund, in your pension account, the plan asset carrying amount will reduce because you have paid from there only you have paid to the retired employees. So that's why it will reduce both plan obligation and plan assets. Benefits paid, okay? This will have no overall impact on the net pension deficit or asset. No impact on the net pension deficit or asset. It will only reduce the plan obligation, plan assets, that's it, the payments, but no impact on the net pension deficit or asset. Remeasurement component. After let us go to the remeasurement component. Like every other, how we remeasure our assets to fair value, non-current assets, intangible assets, investment property, financial instruments, same way we remeasure our employee benefit also, the pension. So after accounting for the above, net pension deficit will differ from the amount calculated by the actuary as the current year end. There will be difference. Amount calculated by the expert versus the net pension deficit. This will be for a number of reasons, that differences and all. Why is it? Because their calculation of the value of the plan application and asset is based on assumptions. They base it on assumptions. What are this? Such as the life expectancy. Remember defined benefit obligation? Sorry, defined benefit plan. There was a formula given to you in the start. Number of years divided by 60 into the service employee, right? Into the salary, final salary. Okay, so they have to make an estimate what would be their life expectancy, what would be their final salary, and also this have changed year on year. So this all are based on assumptions by the expert. But the actual return on plan asset is different from the amount taken to profit and loss as part of the net interest component. Okay, actual return is different. What did you take in the profit and loss account? You took the net interest component. That means interest you are receiving on the plan asset. That is different compared to their assumptions. So that change, that difference is known as remeasurement component. Okay, and must therefore be posted. So where is this remeasurement component goes relating to employee benefits IAS 19? Other comprehensive income. It is credited to other comprehensive income for the year. And that's not enough. You should know that this item will not be reclassified to profit and loss in the future periods. It will always be in OCI. Okay. This is given in IAS 1 also. Like you can check IAS 1 the videos and check that I have listed the items, some items which will be reclassified to profit and loss account, some which will not be reclassified. IAS 19 is one of it, which will not be reclassified to profit and loss in the future period. Now let us go to the conceptual framework. So when developing or amending IFRS standards, board knows that it might decide that certain income or expenses should be presented in other comprehensive income if they might result from remeasuring an item to current value. Right? Most of the standards, IFRS standards says that when you are remeasuring certain income or expenses, better to show it under other comprehensive income. Okay. Profit or loss provides more relevant information, or it provides a more faithful representation of an entity's performance. So it's better to show it in OCI if profit is showing the relevant information and it is a faithful representation, right? So IAS 19 requires the remeasurement component is recorded in other comprehensive income. You should know this. In short, this you should know. Remeasurement is in OCI. And also a defined benefit plan is long-term in nature. Okay. So the board believes it is inappropriate to recognize short-term fluctuations in profit and loss. Why is it in OCI? Because they believe the defined benefit plan is a long-term, no? But profit and loss are recognized in short-term. So they think that it is inappropriate to recognize short-term fluctuations in profit or loss. Therefore, OCI is better. So this protects the statement of profit or loss as the primary source of information. Remember, the primary source of information when you want to look at the performance of an organization, you always go and look at the profit and loss, not the OCI. OCI comes later if people want additional things to see and all. So that is like your primary source. So that should be protected, okay? About an entity's financial performance in the period. Now, so according to the conceptual framework, What did they say about income and expense? That income and expense should be in OCI and it should be reclassified to profit and loss. When doing so results in profit or loss, providing more relevant information, right? If they think reclassification is appropriate, but in this case they don't think it is appropriate, because as they have mentioned before, long term is defined benefit plan is long term. Okay, so in the short term you cannot recognize the fluctuations in the profit and loss account. So the remeasurement component is not reclassified to, that's why it is not reclassified to profit and loss account. Remember that you might need these answers to write your answer when a question is asked whether why they are not reclassified to profit and loss. Please provide logic behind it or reasons or rationals. You might need the support of this, the conceptual framework. So you can write all this answer that because it's long term, so short term, so it's not appropriate to recognize short term fluctuations in profit and loss. These things you can write in your answers. Okay, therefore, at the end, they are concluding that it should not be reclassified to profit and loss. The board argues, and remember, whenever you're talking about reclassification and it needs to be reclassified or not to be reclassified, you have to mention these things. You have to talk about one is conceptual framework, number two about the relevance and faithful representation. These two qualities. Okay, because most of the time conceptual framework talks about this only. Relevant information, or faithful representation. These two qualities. Okay, so you link this reclassification to profit and loss with these two things, conceptual framework and relevant information or not. Then you will be able to write your answer. So the board argues that there is no clear basis to determine the amount, the timing of reclassification. The board thinks that first of all, there is no clear basis. So they should not be reclassified to profit and loss. Second, the timing of reclassification. They don't know when the reclassification will happen. So better not to put it in. Better not to take a risk, they are thinking, and put it in OCI only. Okay. Which is according to me also, I think it's fair enough. Right? So now they are going to summarize. Summary of the amounts recognized in financial statements. Everything is now summarized. Whatever we have gone through up until now. One is defined benefit pension plan. It is broken into three things, three statements. Okay, this is defined benefit. Please see the word, not contribution. If it was defined contribution plan, okay, it's not like this. Right? It's much easier. We have seen previously. We started with contribution, in fact, defined contribution plan. But this is defined benefit plan. So in the profit and loss, two things will go. One is the service cost, one is the net interest. Other comprehensive income, the remeasurement component will go. Statement of financial position, plan obligation, plan asset, asset ceiling. Asset ceiling we didn't cover yet. It will be covered later. So now let us illustrate this. Okay, because this is a very good illustration even from your exam's point of view also. In the revision kit on all you must have seen this. Okay. So at 1st of Jan 2004, the present value of obligation was 140 and fair value of plan asset amounted to 80 million. Okay. So this is the present value 140 at 1st of Jan, that is the opening balance, and this is the fair value of plan net assets, which is 80 million. Okay, even here they have given a plan asset 140 minus 1 is okay. No, these are the closing. So these are the opening balance. Okay, one is for obligation 140, one is for plan assets 80. You have been given the discount rate for both the year, current and the past service cost together. Okay, they are together, they are not separated. Benefits paid, contributions into plan, present value of obligation, and also fair value of planned assets. Determine the net plan obligation or asset. You see the word net plan obligation or asset. Why? Because it could be obligation also, it could be asset also. We'll see what is it. Okay, they did clearly say whether it is an obligation or an asset. At 31st December 2004, that means at the closing year end, they want the closing balance. And amounts to be taken to profit and loss. What amount out of it will go to profit and loss and other comprehensive income for both the financial year. So they need these as well. So the solutions, okay. Now you tell me what things will go with the statement of financial position. we studied in the chart above just now? Three things. One is plan obligation, plan asset, and asset curtailment. So what is, so for that, which amount will go? The closing balance. The closing balance of the plan obligation and plan asset will go there, right? So it's easy. You write the present value of plan obligation. Okay, so this is the opening balance. Okay, and this is the, and you deduct fair value of plan assets in the opening only, in 2004 only, because you want the net. You have to net off your obligation with the asset. So what you're doing is you are deducting your assets from obligation. This is your obligation in 2004. This is your assets in 2004. Fair value of planned assets. So it's 200 minus 120. You deduct this and with 200 with 120. Same for the 2005. You deduct 230 minus 140, and you are getting net liability because your obligation is more than your asset for both. So it's a closing net liability. Okay, 80 and 90, because they have told both the years. Whenever they say both the years, please make it column wise like this. Okay, and usually more than 2 years they don't give. It's 2 years only, so you don't have to worry. Now let us go to the statement of profit and other comprehensive income. In fact, more work is needed in this part. That's why this they have given later. So we know that service and net interest cost will go to profit and loss. We know this. Remeasurement will go to OCI. Okay, remeasurement together with the gain and losses with the returns on plan assets to the extent that they are equal with the net interest component is taken to OCI. Okay, so if you see the service cost 30, 32, 2.4 and 2.4 net interest. Okay, 30 and 32 net interest you have to find out, but the service cost is given 30 and 32. Okay, so discount 4% and 3%. Okay, so that 4 and 3% will go in which amount? That net interest. It will be same only. Okay, because this will remain fixed on in the opening balance. So opening balance means whatever the interest you get in 2004's figure, that only will be used for 2005 also. When it comes to net interest, okay, you have to find out. 2.4. How did you get 2.4? What is the percentage for 2.4? 4%. 4% in which amount? 4% at 80, because this is your close liability. I'm sorry, it's at 80. So 80 into 4%. No, it's not 80. It is 4% in which amount they have. Okay, they have shown here. Reconciliation they have done of the net obligation. Okay, so they have that here. So we'll go there later. We'll keep this net interest component for time being. Let us go to the other comprehensive income. Remeasurement. Okay, so we have to see how the remeasurement component we got from below only will get. And finally, total comprehensive income. You add this profit and loss with the other comprehensive income, it's known as total comprehensive income. Okay, now let us go to the reconciliation. So you start with the balance brought forward. What is it? The opening. Okay, it is 140 minus 80, 200 minus 20, 60 and 80, right? Just let me go to the statement. No, this is not the same thing as a closing net liability. Okay, because if you see here also you have deducted fair value of planned assets with this one. This and this is not same thing. Here you are taking the obligation brought forward, which is 140. You're not taking this present value. Please understand. You're not starting with the present value. This all at 31st December, this amount you are taking for in the statement of financial position. But you have to take this at the 1st of Jan. What is the present value of obligation? 140 and fair value is 80. Understanding? And for the next year, it will be 200 and 120. Okay? So here if you say 140, 80 and 200 and 120 because 31st December. Next we have 60 and 80. It's a net obligation. Okay. So on that we are taking, okay. We are taking 4% on 60. Service component is 30 and 32 as it is. But when we are taking net interest, it is only an obligation. Better to show the net interest part first, I feel, then service cost component because it is on the opening balance. So this 4% is on 60. It will be on this. Same 3% will be on 80. I'm sorry, I made a mistake. I have told that 4% will be on the opening balance only because I just saw the similar figure. So I'm sorry. There I made a mistake. It will be on the 3% on 80. But both are 2.4 in this case. Okay. But the net interest you take on the opening balance only 60 versus 80. So 60 and 80. So 2.4 contributions 25 and 30 you deduct. There were no benefits paid. Okay. Benefits paid you don't have to. It will not have any impact. So even though benefit paid you are given 22, remember it will not have any impact. It will only have impact that it will reduce the plan obligation or asset. Okay. That's it. But it will not have any impact in the profit and loss account or statement of financial position. Therefore, we are not taking the defined benefit paid. Contributions you deduct. Remeasurement is a balancing figure. You have been given the closing balance. This balance have the amounts which you have calculated in your statement of financial position. Remember 80 and 90. Those are your closing figure. Okay. To get the closing figure, again I'm taking you to the statement of financial position. You have to do this amount. Okay. 80 and 90. Practice such type of questions until you get comfortable doing it. So the balance is remeasurement 12.5 and 5.6. Okay. Which you are taking here. Remeasurement will come under OCI. Net interest will go in profit and loss after the service cost component. Okay. Now let us go to the illustration 2, the second illustration. An entity operates a pension plan that provides a pension of 2% of final salary for each year of service. 2% of final salary for each year of service. On 1st of January 2005, entity improves pension. Improves. You see, improves means they are increasing the pension. The rate was 2%, now they are taking 2.5% of the final salary for each year of service, including service before this date. Employees must have worked for the entity to at least 5 years they must have worked in order to obtain this increased benefit. 2% they will get, but to get the 2.5%, they should have worked at least 5 years. At the date of the improvement, the present value of additional benefit for the service is as follows. At the date of the improvement, what is the present value of the additional benefits from the service? Let us see. So, employees with more than 5 years service 150, employees with less than 5 years service 120. Okay, average length is 2 years. Explain how the additional benefits are accounted for in the financial statements of entity. You should know this when benefits are improved or curtailment is there, how to account for them. If you see the solution, it's just 150 plus 120, so 270. Okay. So entity recognizes all 270 immediately as an increase in defined benefit obligation following the amendment to the plan on 1st of January 2005. Okay. This will form part of the service cost component. It will be in the service cost component. Together you have to take all. Whether or not the benefits are vested by the reporting date, it is not relevant to the organization as an expense in the financial statements. What does it mean? Whether or not they are vested in the reporting date? Hmm? So here they have worked for 2 years. They have told that to get the increased benefit, okay, they must have worked at least 5 years in order to obtain the increased benefit. So this they have worked for 2 years, this they have worked for more than 5 years. But why are they taking then full 270? Because they told that the condition is that they should at least work for 5 years. Then why are they including the full amount? Because for improved, okay, they should recognize immediately as an increase in the defined benefit obligation following the amendment to the plan on 1st of January 2005. This will form part of the service cost component whether or not the benefits are. It does not matter whether they have been there for 5 years or less than that. They still will record the full amount in the as an increase in defined benefit obligation. It is not relevant to their recognition as an expense. It should be recognized as an expense only, the full amount in the financial statement. That does not matter whether you are there for 5 year or 4 year or whatever. That change, that increment in benefit. Okay. Illustration 3 is about curtailment. So what does he do? He decides to close a business segment. The segment's employees may be made redundant and will earn no further pension benefits after being made redundant. Their plan assets will remain in the scheme so that employees will be paid a pension. And when they reach retirement, there is a curtailment without settlement. This is a curtailment without settlement. So before the curtailment, the scheme assets had a fair value, 500,000. And the defined benefit obligation had a present value of 600,000. It is an estimated that curtailment will reduce the present value of the future obligation by 10%, which reflects the fact employees will not benefit from future salary increases. Okay, definitely, when you're leaving, you will not have the employees. They will not get that benefit from future salary increases, and therefore will be entitled to a smaller pension than previously estimated. What is the net gain or loss on curtailment, and how will this be treated in the financial statements? When you are having a curtailment, there will be some gain or loss. That also should be treated in the financial statements. How it will be treated? Okay. So we know what is the amount of the obligation. Obligation is 600,000. On that, they told it will be reduced by 10%. So that means by 60,000 it will reduce the obligation, right? Yes. With no change in the fair value of the assets as they remain in the plan. Asset will not change; it will remain in the plan. So the reduction in the obligation represents a gain on curtailment because your obligation reduced. It's like a gain on curtailment. And they should be included as a part of the service cost component. Remember, we told that gain or cost on the curtailment should be included in the service cost component. There are three elements. Remember, one is past cost service, one is current service cost, the other one is loss or gain on curtailment. Okay, so those three will be included in the service cost component and be taken. Where is it taken? Profit and loss account. The net position for the parent following the curtailment will be, so this is it. Before on curtailment, after. Before it was 600, 500, so net obligation, it's a net obligation. Okay, in the statement of financial position, SFP means statement of financial position is 100, but on curtailment 60 will be reduced. So you reduce 60, later it will be 40 here, so 540, it will remain 500 only. Okay, so the gain on the curtailment, obligation reducement is a gain. Okay, so the gain on curtailment is 60,000, and this will be included as a part of the service cost and profit and loss for the year. Okay, test understanding 3 I'll be doing later. Then we have 4, then we have 5. Okay, now let us go to the asset ceiling. What is asset ceiling? See, most defined benefit, we are still in the defined benefit only. Okay, defined contribution, only small part is explained in the beginning, but rest all is on defined benefit pension plans. So most defined benefit pension plans are in deficit. Most are in deficit. That means asset. Defined benefit asset. So the obligation exists the plan asset. Obligation is more than the asset. Okay, although some defined benefit pension plan shows a surplus. If a defined benefit plan is in surplus, IAS 19 states the surplus must be measured at the lower of. If it's in surplus, okay, that means asset is more than obligation. Okay, so that surplus should be measured at the lower of these two things. Remember the measurement when it is surplus, and remember the measurement also when it is a deficit. First, let us go to the surplus. Okay, when it's a surplus, it is the lower of the amount calculated as normal. That means per earlier examples in illustrations. How normally you have calculated the amount, defined benefit plan surplus. Next, The total of the present value of any economic benefits available in the form of refunds from the plan or reductions in the future contributions to the plan. So you find the total of the present value. For example, in a form of refund from the plan or reductions in the future contributions to the plan. You reduce the contribution or you take a refund from the plan. So the total of that present value, whichever is lower out of this two, that will be taken as, if it is in surplus, then that's how it's measured, the defined benefit plan. Okay. So that is known as asset ceiling. You're putting a ceiling to the asset. Lower means lower of this two, you're measuring the defined benefit plan. Surplus means it's a asset is more than the obligation, right? So this is known as applying the asset ceiling. You're putting a ceiling to the asset. Asset ceiling you should know, okay? Whatever we are studying through asset ceiling is also a topic in itself which will come, right? Which has a very high chance of coming in the exam. What does it mean? It means that the surplus can only be recognized to the extent that it will be recoverable in the form of refunds or reduced contribution in the future. What does it mean? That surplus, not any amount. There's a limit to that surplus. There's a ceiling. More than that, it cannot go. Remember ceiling? That is like the top position. More than that, that is like the maximum it can go. So here also, up to the extent. So ceiling is like up to that extent only. More than that, it cannot go. Up to the extent that it will be recoverable in full in the form of refunds or reduced contributions in the future. Are you getting refund or you are reducing contribution in the future? This ensures that an asset is only recognized if it has the potential to bring economic benefits to the reporting entity. Okay, you can only recognize asset when it has, okay, when it has the potential to bring economic benefit. If you have seen, even if in IAS 12 also, deferred tax asset and liability, everything has some part of asset and liability, whether it is deferred tax asset liability, whether it is financial instrument asset or liability, whether it is pension benefit asset or liability, everything asset and liability. And one thing is very common, what I have noticed is, I don't know whether you have noticed it or not, that when anything relating to asset, whether recognition or the measurement or your disclosure, they are more strict in the asset than the liability. The reason is because people want to show more of assets and less of liability. That's why they are more stricter on the disclosure and the measurement of asset than the liability, than the obligation. You understanding? That's why when it is related to asset, there is a whole chapter, long chapters on it. Whether it is deferred tax asset, whether it is financial instrument as financial asset, whether it is your defined benefit plan asset. So everything asset means more disclosure, it's more stricter. Rules are more stricter on that. Okay. So now you know which area you need to study more. That's why asset ceiling. We don't have a obligation ceiling, but asset ceiling, right? Illustration 4. Let us understand this through illustration 4. Asset ceiling. What is the value of the asset that should be recognized in the financial statements? So that, why do they bring all these concepts and all asset ceiling? So that entity does not recognize too much of asset. Then they should. They are putting that limit to it. Okay. Fair value of planned asset, present value of potential liability, present value of future refunds and reductions in future contributions. Okay. So amount will be recognized lower of what? What is the fair value of planned asset? 950. What is the present value of obligation? It is 800. So 800 minus 950, 150. Obligation is less. Therefore, this is a, sorry, I'm sorry, just, you see your obligation is less. So this is a deficit or a surplus. This is a deficit, 150. Okay. And if you see the refund and all, it is 70. So 150 is lower or 70 is lower? 70 is lower, right? So 70 only you will recognize. So asset only up to 70,000 you can recognize, not 150,000. So therefore the asset that can be recognized is restricted to 70,000. Okay. And when you're comparing this 70, don't take with 950. Don't forget that you have to first deduct it with the obligation and find the net asset or net liability. With this only you are comparing. Okay. So now with this asset ceiling is clear, that lower of this test understanding 6. Then we have other issues. Okay, so from other issues onwards, we will be covering this in part 2, because what I wanted to cover I have covered relating to IAS 19, the pension benefit and all. Now this is more than pension. These are some other benefits, other issues. Okay, so which I'll be covering in part 2. So till then, take care and see you in the next video.